go through the argument of Secretary Mnuchin, Saleha, and help me understand how he thinks we get that wage growth without the broad-based price pressure?
Yeah, sure. So what Secretary Mnuchin said was that there are many ways for the economy to grow. He does see wages increasing. He cites that during the Obama administration, when Trump was elected, he was elected on the platform that middle-income Americans did not see their wages increase over the last few years, even though the 1% and stock markets and investors were very, very happy with how the economy was going. And so the tax cuts, he says, will boost wages, but that will not necessarily spill over into broader inflation. One of the reasons is that now the U.S. is not as dependent on other countries and other sources for oil, for energy. With its own oil production, that's not as big of a concern in terms of inflation as far as geopolitical risks go.
So we shouldn't worry about inflation. Should we worry about the debt?
Well, look, he didn't really want to address that directly, including the increasing cost to finance debt. We have seen a little bit of a change among the GOP. They're a little quieter about debt issues. He did say that I asked him about, we had heard from the Director of National Intelligence last week during a hearing. Dan Coates said that the high level of debt is unsustainable and represents a threat to our economic and national security. But Mnuchin said that foreign investors basically financing all of the U.S.'s fiscal stimulus plans doesn't worry him as long as we can continue to fund our military and intelligence operations.
Saleha, great interview, by the way, and thank you very much for bringing us some more insight on it. Thank you. We've got some insight from Jeff Gundlach of Double Line as well on Twitter. Check out these tweets. I'll run you through both of them. We begin with the first one. Mnuchin, policies will raise wages without inflation. Yes, sure. And we're going to expand the Buffalo Art Museum without making it bigger. Then he followed it up with this. If by miracle wages go up without inflation, it's not good for profits. If wages go up with inflation, it's not good for bond yields, ergo PE ratios. That's the view from Jeff Gundlach. Greg, does that add up for you, the view of Gundlach?
Somewhat. I mean, you know, at the end of the day, it boils back down to what I started with, and that's productivity. And so you need to see productivity growth. And so that is the great unknown. And the truth of the matter is, you don't realize that you're in this productivity revival until well after the fact. So it's really hard to tell. But I think what the markets are really concerned about is the fact that you are increasing deficits at a time when you should be building surpluses or trying to. And that is a worry. And quite frankly, the multiplier effect that you're getting from that debt in terms of the economic growth isn't nearly as much as it should be.
And there's an assumption, Tony, that you accelerate into supply constraints. And if you get that wage growth, it's going to challenge profit margins. Now, you're the equity guy. Are we going to have a situation where margins get pressured?
I think that's good for Twitter. But when you look at the data, companies never raise their costs more than they have revenue assumptions. So actually, we have not yet made the peak in margins, despite the increase in the labor costs. So our equity market policies, we believe that we're going to retest that low. It's a human nature trade. We want to buy the quote-unquote productivity trade when you do that, because how do you offset? Why is the yield curve flattening? Ultimately, it's because the Fed is worried about inflation. As a result of that, they're raising rates. The long end's staying flat because they're worried that the higher rates are going to lead to recession. What do you need if you have higher inflationary expectation? Productivity enhancement. So how do you invest in that? Financials, those that finance it. Industrials, those that implement it. And technology, those that are behind that implementation.
Greg?
The one thing that we're hearing from corporates directly is not so much the tax cut being a return to labor or to capital shareholders. It's actually to price cut. You're hearing increasingly from companies that they're using those excess savings to actually cut prices, which actually is a supply shock and disinflationary, not inflationary. I think that's a big unknown, but something to watch.
If you have been curious how to make the money when markets fall, please visit marketcrash.money and get some additional information. Specifically, I have compiled some interesting reasons why stock market crash 2010 is a definite possibility, why we could be going for another Bitcoin crash, and more importantly, how to not let the market crash or the Bitcoin crash take advantage of you. Find out how to profit. If you're a new trader or an experienced trader, but you're looking for new ideas, new ways how to take advantage of the market fall, because quite honestly, markets do fall much, much faster than they go up. So it represents, for a trader, a great opportunity to profit on the opposite direction of the market in a much shorter time frame, and oftentimes maximize much bigger returns. So if interested in knowing the ways how I trade weekly options for huge profits as much as 3,800% to 5,000% on certain days, get in touch with me. Visit this link right here, How to Profit, read some information, and schedule your consultation. I'll be glad to help out and get somebody on the right track and show you some of my profitable ideas and share some experience which I've accumulated over the last 30 years trading weekly options.